Julian Callow joins us. He's Chief European Economist at Barclays Capital. Hi, Julian. So they've tweaked the treaty, a couple of sentences.
That's right. Yeah, not a lot more than that, really. It does seem to be the minimum, really, that we would have been expecting from that. So there is a danger that the markets are going to be a bit disappointed. It's certainly no magic bullet response. I mean, given the intensity of the problems that you've got out there, you know, people out in the markets are wondering, well, what is going to happen? Is there going to be defaults happening next year? Surely Europe needs to come up with some very major package that's just going to calm down the markets. But we haven't really got a lot.
Would you expect to have that in place? I mean, Strauss-Kahn said beginning of 2011. Well, are we looking at that sort of time frame, do you think?
For a default.
For some sort of big magic bullet package to resolve this crisis.
I suppose it doesn't rule it out, but it's disappointing. The trouble with Europe is you have to agree with so many people on everything. So who knows? Maybe it's just going to be a matter of time here. But, you know, what we'd want to see, for example, is the EFSF extended so it can go and buy the debt of these peripheral bond markets directly. I mean, that would be a good start.
Do you see Germany agreeing to that, though?
That's right. It doesn't look like it's agreeing to it, which is why we haven't had any indication on that front. As well, what we'd want to go and see is the ECB really stepping up its purchases of bonds. I think, in the view of many investors, that would be a very good response at this particular stage. But, you know, the ECB announced a capital raising yesterday, but it's in stages. So, OK, it's doubling its capital. Exactly, in one-third tranches. So my interpretation of that is that it's still really quite cautious in terms of what it wants to do in terms of buying future assets. OK, it is going to have more capital and provisions there, but it's not really giving a lot away with that particular announcement.
In the meantime, Julian, we had Greece, Moody's considering, I quote, a multi-notch downgrade on concerns whether it'll be able to reduce its debt to a sustainable basis. Possible or not? Is it going to be able to reduce its debt to that basis?
It's just so difficult, isn't it, for Greece? I mean, this year the budget deficit, 9.5% of GDP. We're talking about this year there's been enormous fiscal consolidation in Greece, around 8% of GDP. Next year they're planning about 6% additional consolidation of fiscal tightening. And yet their debt is still rising very, very strongly. You know, we're going to be hitting 160% in the next couple of years on the debt to GDP ratio. The interest payments on that are going to be around 8%. The interest is flowing outside of Greece largely because that's where the debt holders are. So it's going to be very difficult for Greece to get that on a sustainable footing, I think.
Julian, thanks.
Thank you, Mark.
Julian Callow there from Barclays.